Equity Market Update, February 2022. Equity markets corrected in February 2022, driven by Russia-Ukraine war, rising crude and other major commodity prices, consistent selling by FPIs, rise in risk-off sentiments, etc. Further, rise in global yields, strengthening of dollar, receding of Omicron wave, reopening of economies, etc. also impacted the movements of equity markets. Nifty 50 and S&P BSE Sensex ended approximately 3% lower compared to a month ago. Large caps outperformed mid caps and small caps during the month. Sectoral performance was broadly negative, and most major sectors, except metal, delivered negative returns. Major global equity indices also ended the month lower compared to a month ago. FPIs continued to remain net sellers during the month and sold equities worth $4.7 billion, following net selling of $4.5 billion and $2.5 billion in January 2022 and December 2021 respectively. On a cumulative basis, FPI sold equity worth $13.1 billion in 11 months FY22, compared to net buying of $35.6 billion in the same period last year. For Q3 FY22, results of banks and IT were better than expected, while that of utilities, metals and telecom were largely in line with expectations. Results of auto, consumer staples, cement, oil and gas, NBFCs and pharma were below expectations. Despite recent corrections, valuation of majority of sectors on aggregate basis is close to or higher than long-term averages. Outlook: as on 28 February 2022, Nifty 50 was trading near 17x FY24E price to earnings ratio. While the price to earnings multiple is high compared to historical average, it could be considered reasonable in view of low cost of capital and healthy corporate earnings outlook. Again, the ratio of India's market cap to GDP is 87%, that is, in the range of 60 to 100%, in which equity markets have been during most of the past 10 years. However, the gap between 10-year GSEC and 1-year forward Nifty 50 earning yield is higher than its long-term average. Further, corporate earnings growth is likely to normalize from FY23 onwards, after seeing a robust improvement in FY22. On an overall basis, in our view, most indicators are hinting that on overall basis, markets are no longer cheap. In view of the above, while markets hold promise over the medium to long term, one should moderate return expectations in line with the expected growth in nominal GDP. The market is expected to be largely driven by growth in corporate earnings. We remain optimistic on the economy and the equity markets over the medium to long term, on the back of reopening and normalization of global economy, robust domestic growth outlook, comfortable external sector, likely improvement in corporate profitability, growth-oriented budget, etc. Significant monetary tightening and rise in cost of capital, sharp increase in US yields, persistence of high inflation in advanced economies, sustained impact of Russia-Ukraine war on growth and commodity prices, rise in geopolitical risks, etc. are likely to be key near-term headwinds for equity markets. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.